If you are self-employed, we will tell you how to compute self-employment tax.
Hi there and welcome. Today, we're going to break down exactly how to figure out your self-employment tax here in the UK. All the guidance you're about to hear has been put together by the expert team at ProTax Accountant, and our mission is simple: to give you clarity and confidence, especially with some huge changes just on the horizon. So let's just kick things off with a pretty direct question for every sole trader, freelancer, and small business owner watching this. Are you genuinely ready for what's coming? Because the way you handle your tax is about to change in a really big way. You're going to want to remember this date, April 2026. This is so much more than just the start of a new tax year. It's a massive shift in how millions of us will report our earnings to HMRC. So, getting a solid grip on your tax calculation right now is absolutely critical. So what is this big change? Well, it's called Making Tax Digital for Income Tax, or MTD for short. Starting in April 2026, if you're earning over £50,000 from your business or property, the good old annual tax return is on its way out. Instead, you'll have to keep all your records digitally and send updates to HMRC every quarter. Yep, it's a completely new ballgame, and getting ready for it starts with mastering the basics of your tax bill today. Okay, so before we even get into tax rates or new digital rules, everything, and I mean everything, starts with one crucial number: your taxable profit. This is the bedrock of your whole calculation, so let's get this figured out nice and simple. First things first, we need to know your turnover. Now, don't let the jargon fool you. This is simply the total pot of money your business has earned from everything it's sold or every service it's provided in a tax year. Think of it as your top line figure before you take any costs away. And next, we have allowable expenses. Now, pay close attention, because this is where you can genuinely, legally reduce your tax bill. HMRC lets you subtract the costs of running your business from your turnover. It's pretty logical, right? The lower your profit, the less tax you pay. But the key is knowing what actually counts as a business cost. Okay, so the golden rule from HMRC is that an expense must be wholly and exclusively for your business. And honestly, this catches a lot of people out. Let's make it real. Driving to a client meeting in Birmingham, that's business. You can claim for that. But your daily drive to your regular office, nope, that's just commuting. An overnight stay in Manchester for a conference, the hotel, and a reasonable dinner are fine. But your daily Pret sandwich when you're working normally, you can't claim for that because you'd have to eat anyway. Pro tip here: don't forget you can often claim for a portion of your home bills if you work from home, or for professional training that's relevant to your job. Getting this part right is a game changer. Right then, once you've got that magic profit figure, which is just your turnover minus all those allowable expenses, we can move on to the next step, working out your income tax. And the good news is it's a pretty straightforward 3-step process. So the journey from profit to tax is actually quite simple. We start with the profit number we just worked out, then we take away your tax-free personal allowance, and finally, we just apply the right tax rates or bands to what's left. Let's look at each of those bits now. For the 2025 to 26 tax year, this is the number you need to know: £12,570. That's your standard personal allowance. It means you can earn that much profit and pay absolutely zero income tax on it. It's a huge help. But, and you really need to be aware of this, if you start earning over £100,000, that allowance begins to shrink. Now, this is so important to understand. It's not like your entire profit gets hit with one massive tax rate. Instead, your profit is sliced up into different tiers. So you pay nothing on that first 12.5 grand. Then you pay 20%, but only on the chunk of your profit that falls into that basic rate band. And if you're lucky enough to earn more, you only pay the 40% rate on the slice of profit in that higher band, not on everything. It's a much fairer system. So we've dealt with income tax. But hold on, we're not done yet. As someone who's self-employed, you also need to pay national insurance. And you'll definitely want to hear this part because the rules have just changed, and it's good news for millions of us. Let's break it down. There are 2 types to think about. First, you've got Class 4. This one is the main one, and it works a bit like income tax. It's just a percentage of your profits. You pay 6% on profits between £12,570 and £50,270. Then 2% on anything over that. Simple enough. Then there's Class 2. This used to be a pain. It was a flat weekly payment you had to make. But that's been scrapped. Now, as long as your profits are over £6,845, you automatically get your national insurance credits for your state pension without paying a penny for it. It's a big win for a lot of people. Right, stay with me here. This next point is hands down the biggest cause of financial shock for new business owners. It's called payments on account. And understanding what this is, well, it's absolutely vital for your cash flow.
It's that sinking feeling, isn't it? You get to your first big tax deadline, you've saved up what you think you owe, and then you see the final bill from HMRC, and it's way, way bigger than you calculated. Why does this happen? Well, the answer is all about how HMRC gets you to pay tax in advance.
So here's the deal. Payments on account are exactly what they sound like. They're advance payments for the next tax year's bill. HMRC looks at what you owe for the year you've just finished and basically assumes you're going to earn about the same in the current year. So they ask for half of that future bill upfront. To make this super clear, let's take a real-world example. Let's meet Chloe, a freelance photographer from Manchester. She's had a brilliant first year in business. She's done all her sums, and she's worked out that her total tax and national insurance bill for the year is a nice round £3,000.
So Chloe has her number, 3,000 quid. She knows this is for the tax year that finished last April, and she knows it's due by the end of January. She's been disciplined, she's saved the money, and she thinks she's totally sorted. But here comes the sting in the tail. Because her tax bill is more than £1,000, HMRC says she has to make these payments on account for the next tax year, the one she's working in right now. So on top of the £3,000 she already owes, she also has to pay the first of these advance payments. It's calculated as 50% of her current bill, which is another £1,500. And boom, just like that, the bill Chloe thought was £3,000 has suddenly become £4,500. And it's all due on the exact same day. That's the £3,000 for last year, plus that £1,500 advance for this year. And what's more, she'll have to find another 1,500 quid for the second payment in July. This is the trap, and it's why you have to be on top of your cash flow from day one. Okay, so we've found our profit, we've calculated the tax, and we've hopefully dodged that nasty payments on account trap. Now for the final piece of the puzzle, the practical side of actually filing your return and paying HMRC, so you always feel in control. Here's a simple checklist, your action plan. First, get a separate bank account for your business. It just makes life so much easier. Second, keep clean digital records. You're going to have to do this soon anyway. Third, and if you do just one thing after watching this, please do this. Open a separate savings account, call it your tax pot, and move 25 to 30% of every single payment you receive into it instantly. That one habit will kill almost all of your tax day anxiety. And finally, know your deadlines. And if you're ever not sure, please don't guess, talk to an expert. Right. Now, it's really important that I'm clear about this. Everything we've talked about today is for general guidance, and it's all based on the tax rules for the 2025/26 year. Tax laws can and often do change, and of course, everyone's situation is unique, so you really shouldn't use this as the only basis for your financial decisions. If you want personalized advice that's built around your specific business, then we highly recommend getting in touch with the experts who helped put all of this together, Pro Tax Accountant. You can get them on WhatsApp or give them a call on 07985 689112 or just drop an email to info@protaxaccountant.co.uk. And of course, for more straightforward, simple tax guides just like this one, we'd love it if you'd subscribe to the channel. Thanks so much for watching.